Your 401k is missing this tax-free account, and nobody is talking about it. Most people believe there are only three places to build tax-free retirement income: a Roth IRA, an HSA, and if you are lucky, a pension. What if I told you there is a fourth account, one the IRS already knows about, one that has existed for decades, and it is sitting inside the balance sheet of almost every wealthy retiree in America right now, doing nothing? Not because it does not work, because nobody told them how to use it. I am James Caldwell, and in the next 10 minutes, I'm going to show you what this account is, why it works, who it works best for, and the hidden traps inside it that turn a perfect tax strategy into a very expensive surprise. If your retirement portfolio is over $1 million, stay with me until the end. There are three specific traps built into this strategy that apply directly to portfolios at your level, and most advisors never mention any of them. Here is what is happening to affluent retirees across America right now. They saved well. They invested consistently. They followed every rule the financial system gave them, maxed out the 401k, rolled it into a traditional IRA, left it alone to compound. And now they are sitting on $1 million, $2 million, sometimes $3 million in a qualified account. And every single dollar of it is going to be taxed as ordinary income the moment they touch it. Not at the capital gains rate, not at 15%, at ordinary income rates. The same rates that apply to your paycheck. And at age 73, the government does not wait for your permission. Required minimum distributions arrive whether you need the money or not, on the IRS's schedule, at the IRS's rate, year after year for the rest of your life. The freight tax train is coming. The only question is whether you are standing on the platform or still standing on the tracks. The retirees who escape this trap are not smarter than you. They did not have a different income. They did not have access to some exclusive planning firm. They had one piece of information that most people never receive. And that is what I am giving you today. Here is the account nobody talks about. It is called a taxable brokerage account. Some people call it a single account. Some call it a joint account. Some call it simply an investment account. Most retirees treat it as the least interesting item on their entire balance sheet. Decades of appreciated investments sitting quietly, doing nothing. But in the right hands, with the right plan and the right income management, a taxable brokerage account can function as a genuinely tax-advantaged retirement vehicle. No contribution limits, no income phase-outs, no 5-year waiting period like a Roth, no mandatory distributions. So how does it become tax-free? Through what I call 3-gear coordination. Gear 1, the 0% capital gains window. Long-term capital gains, profits on investments held longer than 1 year, are taxed at one of three federal rates: 0%, 15%, or 20%. The rate you pay depends on your taxable income. And taxable income is not your gross income. It is what remains after your deductions. For a married couple, both over 65, filing jointly in 2026, standard deduction, $32,200. Additional age deduction, both spouses, $3,200. New 2026 senior bonus deduction, One Big Beautiful Bill Act, $12,000. Total deduction, approximately $47,400. That means a married couple in the pre-RMD window can harvest up to $76,000 in long-term capital gains at the 0% federal rate before capital gains tax begins. $76,000? Federally tax-free every single year. Gear 2, the pre-RMD window. Between the day you retire and the day required minimum distributions begin at age 73, you are in complete control of your income. That window, typically 5 to 8 years, is the most financially valuable period in your entire retirement tax life. Most retirees waste it completely. They take nothing from the IRA and wait for the government to force the issue. Or they pull money out without a plan and accidentally push themselves into a higher bracket. The right move is to use this window with surgical precision, harvesting gains from the taxable brokerage at 0%, leaving the IRA untouched and letting the tax clock run in your favor instead of against it. 8 years at $76,000 per year equals $608,000 captured at zero federal tax, permanently out of the IRS's mandatory distribution machinery. Gear 3, the estate planning advantage. Here is the feature of the taxable brokerage that almost no one discusses alongside Roths and traditional IRAs. It is called the stepped-up basis at death. Assets held in a taxable brokerage account until death receive a complete reset of their cost basis to fair market value at that moment. Unrealized gains accumulated over an entire investment lifetime pass to your heirs with no capital gains tax owed whatsoever. Compare that to a traditional IRA, where your heirs pay ordinary income tax on every dollar they inherit over a compressed 10-year timeline. 3 gears, 1 integrated strategy, and none of it requires a Roth. Now, here is what the viral version of this strategy never tells you. There are 3 traps built into this approach that can quietly reverse every dollar of tax savings you thought you were capturing. Trap 1. The Social Security tax torpedo. Capital gains income, even at the 0% rate, is not invisible to the IRS when it comes to your Social Security benefit. The IRS uses a calculation called provisional income to determine how much of your Social Security is subject to federal tax. Provisional income includes your AGI, which includes capital gains, plus 50% of your annual Social Security benefit. For married couples, if that total exceeds $44,000, 85% of your Social Security becomes taxable ordinary income. What this means in practice? A retiree who harvests $40,000 in gains at 0% without accounting for this interaction can end up with a Social Security tax bill that erases a significant portion of the benefit they thought they were capturing. For someone in the 22% bracket, the effective marginal rate can climb toward 40% in that provisional income band. The 0% strategy still works, but it requires managing your total income picture with precision, not just the capital gains line in isolation. Trap 2. The ACA subsidy cliff, pre-Medicare retirees. If you retired before age 65 and are purchasing health insurance on the ACA marketplace, capital gains count toward your modified adjusted gross income. In 2026, ACA premium subsidies are only available to individuals with MAGI below 400% of the federal poverty level. For a single filer, that is approximately $62,600. Cross that line by $1 and you lose the entire subsidy, not a portion of it, all of it. The average 60-year-old above that threshold faces unsubsidized premiums exceeding $1,200 per month. That is over $14,000 per year in additional healthcare costs, triggered by what looked like a tax-free transaction. The correct approach is not to avoid harvesting gains. It is to identify your subsidy cliff threshold first, work backwards to determine how much income room remains, and calibrate the harvest within that window. Trap 3. The net investment income tax, portfolios over $1 million. For retirees with substantial portfolios, there is a 3.8% federal surtax called the net investment income tax, sometimes called NIIT. It applies to single filers with MAGI above $200,000 and married filers above $250,000. Those thresholds have not been adjusted for inflation since 2013. As portfolios grow and required distributions rise, more retirees cross those thresholds than ever before, sometimes in a single year where a large gain harvest pushes them over without warning. At that point, what was designed to be a 0% transaction becomes a 3.8% transaction, and potentially higher once you factor in the Social Security interaction. None of these traps disqualify the strategy. They define the conditions under which it operates and the precision it requires. Here is why 2026 is the year to act. For nearly a decade, retirement planners warned that the Tax Cuts and Jobs Act was set to expire. Higher tax rates were coming. The window was closing. On July 4, 2025, that uncertainty ended. The One Big Beautiful Bill Act made the individual tax rates permanent. It added the new $6,000 per person senior bonus deduction, $12,000 for a qualifying couple, which runs through 2028. For the first time in years, you can plan with absolute certainty. The foundation is solid. The window is open. The strategy is executable right now. Every year you sit in the pre-RMD window without a gain harvesting plan is another year of zero-rate extraction capacity that expires unused. The freight tax train is not slowing down. It is picking up speed. And the station you are standing at closes at age 73. If you are sitting there thinking, I saved well, I built this, I thought I had this figured out, that is exactly what the retirees think every year right up until the RMD notice arrives. The question is not whether the freight tax train is coming for you. It is. The question is whether you do something about it while the window is still open. Click the link below and book a private one-on-one 401k rescue strategy session with my team. We will look at your numbers, your timeline, your tax situation, and show you exactly how much you can rescue at zero tax before the government forces the issue. Not a sales call, a working session. You have spent 30 years building this. Spend 30 minutes protecting it. Rescue, reclaim, retire richer.